I just look at the individual bar chart. I look at the size of the bar. I look at reversals in the bar. I look at fundamental numerology. I look at time periods and time frame persistences. Volume I sometimes look at, but it's very misleading because there's a lot of synthetic stock that's created with options and futures. The basic trend is a pattern, and I emphasize pattern. An uptrend has higher highs and higher lows. A downtrend has lower highs and lower lows. And this is a pattern. The reason you have to understand it's a pattern is, let's say you have a weekly chart declining like this. It may take a whole week before it starts to turn up. But if within the weekly chart you have an hourly chart that is making a bullish pattern, then that will lead to a daily chart pattern, and then that can turn your weekly chart. So you can actually get in on a weekly chart time frame near the exact low once you see the pattern change. So no matter what you think about the market and whether you got the candlesticks and wicks and anything else, but the institutions who run the market up always trade on the bid side of the market. And the orders are on the bid side. They don't chase it up every day. And so at the final high bar, whenever you find the highest bar of the move, when the bid side disappears and it's done, it's exhausted. There's no more buyers, and you get a reversal in trend when the low of the high bar is broken. That's your sell signal. Also, on the way down, the institutions use limit orders. So even though you may have a big bar at the bottom and you may spend several bars down here several weeks, there's usually a limit order up here to sell that you don't see. And so eventually they work their way through that limit order, and when they get above the high of the low bar, you get a buy signal. Now, of course, this will happen quite frequently with 1 minute chart or 5 minute charts, but obviously when you get to the longer term charts, the trends are longer. Now, this is because of persistence of trends. That's the only reason technical analysis works, because of cyclic activity in the market. When the cycles turn, there is a persistence of trends. Usually after reversal bars, the new trend goes in a Fibonacci number of bars, like 3, 5, 8, 13, 21, 34. So it's important to keep track of your time frames. As a reversal on a 1 hour chart may see a trend for 3 to 5 hours, which is almost a full day of trading, whereas a daily reversal is 3 to 5 days, and a weekly is 3 to 5 weeks. There is no need whatsoever to keep watching every day for a reversal if the weekly or monthly charts are going in a new direction for 3, 5, or 8 time periods.